Hello everybody, Keppel this REIT just announced the numbers for FY22 and the numbers are pretty much smack in line. The numbers are actually very consistent for good reasons that we'll talk about subsequently. But I think in general, I think the theme and the story for this guy continues on. It's going to be continued growth through a combination of inorganic M&A growth and organic DPU growth through AIs and stuff. The share price has been quite interesting. You see, during the panic selling in October period, the share price went to 1.6. So pretty much in the span of 6 months or something, the share price went back in time by 3 years to 2019 levels. So that was amazing, right? This is the power of panic selling in the financial markets. 6 months of a share price fall brings you back in time by 3 years. But I didn't buy a whole lot of this stuff during October because actually if there wasn't other alternatives, I would definitely have bought it because the DPU is quite easy to expect, around 10 cents, and at the share price of 1.6, it was yielding at 6.5, 6.6%, right? So in normal times, it would be attractive, but unfortunately for this period, things were just collapsing all over the board, right? So I chose to buy other stuff which are cheaper on the valuation perspective. So I bought a bunch of AIMS and Star Hill and Keppel REIT, which I talked about in this video over here. So this stuff, AIMS was trading at 8.5%, huge discount to book. Star Hill is also the same thing. Keppel REIT as well. So on valuation reasons, I was buying other stuff and not this stuff. But on hindsight, maybe I should have bought this stuff because although this stuff was yielding a lot lower, but this stuff has been very, very much well liked by the institutional investors, right? So you can see that for the past 1 month, once the fears of inflation has receded and rate cuts are now starting to price into the market, this stuff has rebounded very fast, right? So on the 1 year perspective, 1 month perspective, year to date, this stuff is up 14%, right? Compared to this stuff like 5 to 7% only. So actually this guy is very, very responsive to the market. I think the price action shows me that the this stuff, a pure data center focused REIT, is still very much in favor, and there's a story continuing amongst the institutions. The DPU is up 4% for the year, and the increment is quite easy to understand as well. It's a combination of inorganic M&As through the data centers in China, London, and Eindhoven in Netherlands, as well as organic growth through AI's rental escalations, right? So, well, the top line is increasing, but the anchored by the long leases that they have. So well of 8.4 years. You can see the profile over here. Majority are ending in only 2028. So the top line is very well secured and increasing. And quite interestingly, the impact of tariffs it's not that big for this guy because most of it is passed through the colo clients. And on the bottom line, it's not affected much by interest costs because well, most of our debt is fixed and long, right? So like 10 plus 3 plus 6, so around 20% of the debt will mature in the next 3 years. So very, very low, right? So there's nothing much to worry about the debt front. If you look at the ICI is at 7.6 times, debt tenure is at 3.7 years. Cost of debt is increasing, but not that crazy. Interestingly, the leverage is going down because of valuation gains. Look at the debt profile. Most of the debt is also fixed, so nothing much to worry about in terms of debt. Very low maturity in the next few years, and most of it is fixed. The only thing that is worth looking at is the profile of the FX impact. So if you look at the euro borrowings and the sterling borrowings, it's around 50% of the total borrowings. So they have kind of overhedged in the euro and the sterling currencies versus the AUM. So well, if there's one thing to pick on, that will be probably the only thing. So quite interestingly, the NAV actually went up from 1.34 to 1.4. So this is amidst fears of cap rate rising and capital values depreciating and gearing busting and stuff, right? And interestingly, the premium to book has also narrowed. 1 year ago, this was trading at 1.8 book. Now it's 1.26 book. So actually, if we bought the stuff at 1.6 and the revised NAV of 1.4, actually you could much bought it at close to book, which is quite a snatch actually. Too bad I missed the opportunity, but maybe there'll be more opportunities for the next 1 year, right? Because there's still plenty of volatilities ahead. I was looking around for the valuation to see what the assets actually grew, but they didn't give a specific cap rate for each asset, just a range, right? So look at it, the cap rate for last year was 4.4 to 931, and this year is 3.96 to 1155. So this is super wide, right? This is like 5% range, and this is like 8% range. So it's a bit pointless, right? But I can look at it quite clearly. For APAC region, stuff are compressing. So 525 to 875 and 475 to 775. So stuff in the APAC region has compressed by 50 basis points to 1%. So I think APAC DCs are still very much in demand, maybe because of low supply or something. Whereas in Europe, things are getting a bit more uncertain. So you can see that the range have widened from like 5% to 8%, right? Especially over here, right, 11.55%. So I think the situation in Europe is quite dire, right? Utility prices spiking because of the Europe Ukraine war, and then the ECB and BOE hiking rates like crazy, and then recession fears and so on and so forth, as well as I think Euro fragmentation fears now once the ECB starts hiking rates to 5%. I don't know if it will happen, but I think the situation in Europe is looking quite dire. But I think what is interesting though is that if you look at the current cost of capital, the yield of the equity is now 5.5%, right? So the share price is $2 and the DPU is like 10 cents, right? So it's around 5%, 5+%, depends on the share price, which is so volatile nowadays anyways. The yield on the debt, so I think if you want to borrow cost for the next 3 years, 2 years and fix it, it's probably around 4 to 4.5%. Anyway, it's less than 5%. So if you look at the equity and then look at the debt, so the total cost of capital is around yield of the capital, the cost to service the debt plus equity is around 5.5%, right? And then if they can go to APEC and buy some stuff around the 7% cap rate region, or if they take on a bit of uncertainty and buy some of this badly sold off DCs in Europe at 10%, actually the pickup is very, very substantial. But of course, a high cap rate doesn't mean a good asset lah. A lot of due diligence have to be done. But nonetheless, the spreads are still positive though. Unlike a lot of other assets classes, where actually the spreads have turned negative, so it's not positive to do any accretions. So I think for this guy, deal making is still key, especially if the borders now reopened and the teams can now go all over the world. They can buy in China, they can buy APAC, they can buy Europe, they can buy US, they can buy everything actually. As long as the spreads are still positive, right? So as long as the equity is still well supported, I think deal making is still key for this guy. On top of on top of organic AEIs, rental escalation due to CPI indexations, and so on and so forth. I think growth story for this guy is still very, very intact. So let's look at the 2023 and see whether or not there continues to be some opportunities for this guy.